Ladies and gentlemen, good day and welcome to Care Ratings Limited Q4 and FY24 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs and opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performances and involve risks and uncertainties that are difficult to predict. As a reminder, all participants' lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mehul Pandey, Managing Director and Group CEO. Thank you, and over to you, sir.
Good afternoon, everyone. I hope all of you are doing well. I extend a warm welcome on behalf of the entire CareEdge family to the Q4 and FY24 investors call. First and foremost, I would like to thank all the investors for having reposed faith in us and have supported all throughout. Many of you have been kind enough in terms of suggesting to us new areas to focus upon, and I deeply value that. I trust that each of you had the opportunity to thoroughly review our quarterly results. Today, we have with us all my colleagues who are a part of this senior management of CareEdge family. I am interacting with you to provide an in-depth analysis of our company's performance over the past quarter and to address any queries you may have following my initial remarks. Let me start by talking about the macroeconomy. Despite facing headwinds from various global fronts, the Indian economy showcased remarkable resilience in the past year. We encountered challenges stemming from weakening external demand, geopolitical tensions, and weather-related adversities. Yet, amidst these hurdles, our domestic economy stood strong, demonstrating robust growth estimated at a healthy 7.6% in FY24. This growth was propelled by a buoyant cross-fixed capital formation, which surged by 10.2%. Largely attributable to the government's focus on capital expenditure. However, we did witness subdued growth in private consumption, primarily due to the weather-related uncertainties and slow rural demand recovery. On a positive note, urban demand remained robust and the anticipation of a favorable monsoon augurs well for rural demand recovery in the current fiscal. In terms of investments, while government-led capital expenditure continued to drive the growth, the private sector's capex remained sluggish. However, there are promising signs with the manufacturing sector's capacity utilization surpassing the long-term average and higher investment announcements indicating an improving intent to invest. We believe that facilitating private capex will be one of the key parameters in policy framework of the future as well. On the financial front, fundraising through corporate bond issuances increased by 19% to rupees 10.2 lakh crore in FY24, whereas the issuances of commercial paper remained stable at rupees 13.8 lakh crore. Bank credit to industries grew by 8.5% in FY24 compared to 5.6% last year, largely driven by 7% growth in large industries. However, some moderation was witnessed in credit growth to NBFCs and personal loans due to the increased risk weightage for credit disbursement. Externally, India's current account position remains favorable, supported by healthy performance in services, exports and remittances. We expect improvement in merchandise exports this fiscal year, and our inclusion in global bond indices is anticipated to bolster foreign portfolio investment inflows. In conclusion, while the Indian economy stands comfortably compared to its peers, we must remain vigilant of challenges posed by volatile commodity prices and geopolitical uncertainties. By navigating these challenges prudently, we can ensure sustained growth. At Carriage, we stand ready to confront the challenges ahead with unwavering determination, and our commitment to excellence has never been stronger. In order to strengthen our brand presence in the market, we have embarked on an extensive outreach campaign. Our teams in ratings, economics, and industry research have been tirelessly working to produce high-quality content, resulting in an impressive output of 329 reports in FY24. These reports cover a wide range of topics, from timely updates to in-depth analysis, and have garnered acclaim across renowned publications. Moreover, our senior management, sector specialists, industry research team, economic experts, and business development leaders actively participated in over 100 knowledge-sharing forums during the fiscal year. This commitment to sharing knowledge and expertise underscores our dedication to driving growth and progress within our industry. In addition to our written content, our presence across media platforms has experienced a significant surge over the past year and continues to expand in the current quarter. From our power-packed monthly edition of Foresights to engaging blogs and thought-provoking podcasts, we are actively disseminating valuable insights to our audience. As we move forward, let us remain steadfast in our pursuit of excellence and innovation. Together, we will continue to elevate Carriage to new heights of success. Let me turn now to our business performance. Firstly, I am happy to share that the Board of Directors has recommended a final dividend of Rs 11 per share at a face value of Rs 10, which will take the total dividend declared for the year to Rs 18 per share. On the performance, on the standalone business, which is the India ratings business, for FY24, Carriage reported revenue from operations of Rs 283 crores, registering a growth of 14% over FY23, as the initial ratings business continued to witness strong growth. The FY24 operating profit stood at Rs 128 crores, a growth of 10% over FY23. The operating profit margin stood at 45%. Our PAT was Rs 119 crores, a growth of 15% over FY23. I would reiterate that our financial performance should be assessed on an annual basis rather than on a quarter-to-quarter. Nevertheless, for Q4 FY24, the standalone business revenue from operations stood at Rs 75 crores, a growth of 10% over the corresponding Q4 of FY23. The PAT in the quarter stood at Rs 35 crores, a healthy growth of 35% over Q4 FY23. Turning to our consolidated business performance, for FY24, we reported revenue from operations of Rs 332 crores, registering a growth of 19% over FY23. The operating profit margin stood at 34%, and FY24 PAT was at Rs 103 crores, a growth of 20% over FY23. For the Q4 consolidated business performance, the revenue from operations stood at Rs 90 crores, a growth of 16% over Q4 FY23. PAT was at Rs 25 crores, a growth of 22% over Q4 FY23. As of FY24, there is a shift in our business mix with our rating to non-rating ratio now standing at 90:10 compared to 94:6 in FY23. The shift comes on the back of the rating segment growth of 14%, while the increasing contribution is witnessed from the non-ratings businesses. A notable aspect of our performance lies in our investment in subsidiaries. While these entities are demonstrating promising growth reflected in their top-line figures, where the analytics division of our subsidiary has shown more than 100% growth over a small base of last year on the top line, while investing in people, products and technology and operating at a similar loss as compared to the last year. The advisory consulting division has actually shown more than 65% growth on the top line and becoming marginally profitable. However, we remain optimistic about the trajectory of our non-rating subsidiaries. As they continue to mature and generate profits, we anticipate a corresponding improvement in our consolidated EBITDA percentage over time. This underscores our commitment to nurturing long-term value creation and reinforces our confidence in the strategic direction we have charted for sustainable growth. I would like to now touch upon some key initiatives taken to diversify our business offerings. Our subsidiary CARE ESG Ratings Limited shall function as an ESG ratings provider after having received the approval from SEBI on 2nd May 2024. The CARE ESG ratings will enable the issuers to discern steps towards the betterment of its sustainability performance by comparing itself to industry benchmarks and by gauging its relative standing amongst its peers. We have been making efforts on the ESG side over a couple of years, and we believe that with this approval to operate as an ERP, we shall be able to provide value addition to the users of such ratings. CARE shall offer sovereign credit ratings and global scale rating of the debt securities through its entity incorporated in IFSC GIFT City. We believe that with the inclusion of India's debt in the global bond indices, it will enhance the fund flow into the country, thereby creating opportunities for such ratings. Our subsidiary, CARE Ratings Africa Private Limited, has signed MOU with the African Peer Review Mechanism APRM in the area of credit ratings. We are optimistic on the growth potential in this new business lines and look forward to their contribution in the growth of CARE Edge Group. As a part of our transformative journey, we have invested tremendous effort in enhancing and automating the rating processes and improving efficiencies across organizational functions. Our aim of becoming a tech-driven hub remains unwavering, and we will continue to invest in our people, technology, branding and growth initiatives to achieve this goal. CARE is exploring ways to leverage large quantum of data and apply the layer of generative AI to enhance the analyst productivity. We are also exploring the use case of AI in strengthening our internal controls. Lastly, I would like to highlight some of our ESG achievements and commitments. With our persistent efforts, CARE Ratings was able to reduce its energy intensity per employee by 8% on a YOY basis. Our scope 1 and 2 emissions declined by 13% on a YOY basis. CARE Ratings average gender diversity was maintained at a healthy level of 40%. CARE has formalized the policy and commitment to be an equal opportunity provider as an organization. I thank you all for your continued support and appreciate the contribution from my colleagues and the entire team at CARE Edge for their continued hard work. I can now open the floor for the question and answer session.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah. Hi, good afternoon. Congratulations for strong results in the year gone by. Sir, I have a few questions. Firstly, on domestic ratings business. So there has been slight moderation in the domestic ratings revenue growth in Q4. Is it largely reflective of the moderation witnessed in the bank rate growth to NBFCs because of risk weight changes? And was our market share stable or is it improving? Can you comment on this?
Thanks, Rajiv. You're right that quarter 4 has witnessed a slight dip as far as the overall growth as compared to the previous quarters. But more or less, we have been able to maintain the trajectory of our growth all throughout the 4 quarters. As you would have witnessed, right from quarter 1 of the fiscal, we have been registering double-digit growth, and we are happy that we are able to maintain it all through the quarters. We do believe that in this kind of an industry, there could be some fluctuations which can potentially happen in some of the quarters. That is why we always emphasize in terms of looking at the things from an annual basis. And we believe that in quarter 4, as well as on an annual basis, we have registered a decent growth. Your question in terms of the NBFC sector impact, like to some extent, what happens across the segments of the economy, they do have a bearing in terms of how the credit flow to that segment could be happening. But as a full service rating agency having its presence across the segment, we are always prepared for this kind of fluctuation. And because of that, we are able to negate what could be impacting one sector by our presence in the other sectors as well.
Okay. And broadly, our market share in the overall industry volume, maybe in terms of quantum or in terms of mandate, is it stable? Is it improving? Can you comment on this?
Yes, Rajiv. So, to a good extent, we have been able to improve as far as our market share is concerned, right? And there could be varied components of looking at it. One of the things that we always look at, and in a highly competitive industry, it's always the fact that how much of an incremental rating requirement has been there during the year. And we believe that we have done well on that count in terms of improving our share as far as the incremental number of entities which would have been rated across the rating agencies. And if you would have witnessed all consistently, all the full 4 quarters, we have been emphasizing on this aspect that the initial ratings have been driving a significant, they've been giving significant contribution to our growth performance for all the 4 quarters. So we've been able to maintain that thing. So we believe that with the kind of a competitive scenario that we have in the industry, we have done well.
Okay. And this question on ratings segment margin that we report in the segmental pickup. So over the last 2 quarters, the margins have been trending better on YoY basis. So now we are delivering better margin. Is it purely a function of operating leverage, or are there other positive dynamics like the segmental mix or sectoral mix or pricing, or maybe incremental wallet share gains? And can you comment on this? And then whether the margins can further go up if the growth were to continue?
Rajiv, this industry is actually a high operating leverage industry. Right, so that has a significant impact in terms of how the margins they tend to play out. At the same time, one of the points that you mentioned later in your statement is in terms of the increasing wallet share from across our clientele. That also helps in terms of having a certain boost in some of the quarters. But largely, operating leverage has a significant role to play.
Okay. Just one question last on analytics business, where you are very positive on growth. Uh, So what underpins your expectations of this sustained strong growth coming? Maybe you can elaborate in terms of our strategy, go-to-market strategy, product, and client sourcing, client retention, and how quickly can we, improve margins here because we are making loss, and what can be the eventual level of margins for this business?
Broadly speaking, it has been a case of prioritization of the key areas where we have been working upon as far as the product development is concerned and getting to the GTM stage. So during the year, we reassessed these aspects and identified some of the products where we could see the market gaining traction on this. Right, and we focus more in terms of getting those products developed faster as compared to the other ones where we were putting our resources. So that has helped in terms of ensuring that the top line growth that we have witnessed from that entity, that has improved significantly. Yes, there are losses, and these are difficult businesses to build and grow for the future. But we believe that the kind of traction that we have witnessed in this fiscal, it gives us the confidence in terms of taking the things forward in a much more positive and a stronger manner. Nevertheless, I will also request my colleague Abhishek, who is leading this vertical, to give his comments as well. Abhishek, you would like to say something?
Yeah, sure. So as Mehul mentioned, that we have reprioritized a few products and taken some products to market where we feel that the potential for growth is higher, specifically around the credit monitoring and the credit risk products that we wanted to build and we are good at. So that's something that is driving growth, and we are confident that we will see higher margins as we go forward.
Okay, thank you and best of luck. I have a few questions. I'll come back in this.
Yeah, thank you, Rajiv.
Thank you very much. The next question is from the line of Varun Bang from Bandhan Life. Please go ahead.
Yeah, good afternoon and thanks for the opportunity and congratulations for steady performance. So first question is on the rating business. So given our business model, I mean, just like you mentioned, we are a fixed cost business. So what source of business or what percentage of business would be, how do we look at this business? I mean, do we look at it at an absolute basis, the issue price, or you look around the yield when you compete with your competitors? And how do you internally think about those aspects? And if you can just talk about the competition, let's say if it is looking at the fixed price, how do we change our stance there?
Varun, can you slightly elaborate on the fixed cost aspect and the yields that you mentioned? What exactly you are trying to understand from us? Would you slightly elaborate, please?
So I'm just trying to understand the competitive dynamics in the rating business. So when we compete on a few mandates on the rating side, do we look at the absolute issue price or you think about the yields when you give a quotation? How do you internally think about those aspects?
See, this is in our case, let's say in our kind of an industry, this is a combination of all aspects, right? So, it's especially if we are looking at the things from the perspective of what is the quantum that we are going to rate and at what price. We also have to factor in that with whom are we dealing, in the sense that it's an existing client. I mean, in that case, there always is a high operating leverage component which gets into that, right? As compared to, because the efforts that we have to put in while we are dealing with a new client as compared to an existing client, they tend to differ, and corresponding the margins also they tend to differ on that count. But in a broader sense, the rating agencies, the pricing is linked to the overall quantum of the debt size to be rated, right? So from that perspective, there is a certain element of stability on those counts. Nevertheless, the focus on in terms of increasing the wallet share, and in certain areas, in certain segments, they have their own dynamics when we built it, which we built up into our pricing on those counts.
Okay. And secondly, on the African subsidiary, how long will it take to establish our presence in Africa, and how do you think it should pan out because it is all about gaining confidence of investor community, and I think that would take some time. So how are we thinking about moving there? What kind of a groundwork do we need to do before we establish our presence? And lastly, over 3 to 5 years, what is the reasonable expectation in terms of revenues in Africa?
Okay. I think the African business has to be looked from a slightly different perspective. See, when you are mentioning about subsidiary, it's not just a question of one subsidiary. Today we are having two subsidiaries in Africa. One is already up and operating, right? The other one is just established, and where we are awaiting the regulatory license. So if we are first talking about the subsidiary which is already operating since 2015 now, right? It has been already a profit-making proposition for us, and it's a profit-making, dividend-paying entity for us, and largely the value creation that we have done by investment in that subsidiary, that is substantial for us, right? And from that angle, another aspect is that when we have established a subsidiary in South Africa, which is a step-down subsidiary for us, for the parent company, right? The entire investment in South African subsidiary is also done by the Mauritian entity, which is our direct subsidiary. Okay? So from that angle, it has been able to take care of all its expansion plans over there. Yes, the South African subsidiary that we have established, the license is under processing by the regulator. And while it could be difficult in terms of hazarding a guess on the exact timeline by which the regulator shall process the license, but our expectation is that in the first half of the current financial year, we should be getting the license from the regulator. Okay. So if you alluded to these two subsidiaries, then this would be the perspective from my side.
Got it. And any expectation in terms of revenue in those two subsidiaries? So together over next 3 to 5 years?
I believe that the South African subsidiary, while it shall be expected to start the operations during the current financial year, in the initial phases, it would be taking some time to stabilize, just as our Mauritian subsidiary did, right? Because in this kind of markets, it is also a fact that the ratings are not mandatory in that sense, right? So it's the creation of the market that we need to do over there. In Mauritius, we have successfully displayed our capability in terms of creating the market, and in the process, we have grown quite good over there, right? And from the perspective of how the overall trajectory would be, I believe that these subsidiaries shall see a good potential. For South Africa, especially the overall bond market size is fairly significant, right? So from that perspective, having been getting our presence over there for the future should augur well because of the sheer size of the overall market as compared to Mauritius. Right? So we are confident in terms of the growth in these businesses. It will not be possible for us to give any specific number if you are asking for the next 5 years. But we believe that the success that we have demonstrated by value creation in Mauritius, we should be able to take it to our South African venture as well.
Okay, sure. And on the non-rating side, if you can just give a sense of what kind of a mandates are we getting in analytics and advisory subsidiary, and what is our sustainable advantage in those mandates? Product-specific comments would be helpful.
Both these divisions of our subsidiary, Care Analytics and Advisory, the Analytics division and the Advisory Consulting division, principally the mandate flow over there is contingent in terms of the entire product offering. So turning first, as far as the Analytics division is concerned, largely the clientele is in the BFSI segment. So principally the mandates that we have got during the year are from the banking and financial institutions as well as the NBFCs, both in India as well as outside India. As far as our advisory consulting business is concerned, the mandates basis the entire product mix that they are having in terms of corporate advisory, in terms of research, in terms of the ESG advisory. So that is across the segments of the corporate landscape. This in terms of the large corporates, they have also got from the mid corporates, they have got from the financial institutions. So it's an across the strata of the offering. This is the kind of a full bouquet of advisory service that they are providing. So largely the clientele is emanating from this segment.
Okay. And lastly, on the
Oh,
ESG
sorry
rating
to
side,
interrupt, Mr. Varun. I request you to rejoin the queue for your follow-up questions. Thank you. The next question is from the line of Sahil Doshi from Thinkwise Wealth Managers LLP. Please go ahead.
Hi, sir. Good afternoon.
Good afternoon.
Yes, so the question pertains to the non-rating business. I think this quarter we've seen a fabulous monetization or pickup in revenue momentum. However, the expenses continue to increase. We see almost 6 crore worth of EBITDA loss and other expenses of 10 crore versus 5 crore. So could you possibly invest?
Sorry to interrupt, Sahil. You are not audible. Can you repeat your question once again?
Yeah, my question pertains related to non-rating.
Sir, you are not audible.
Okay, so am I audible? Is it better now?
Yes.
It's better.
Yes, sir, please.
Yeah, my question pertains related to non-rating business. I think if I see from Q3 to Q4, the other expenses are increased from 5 crores to 10 crores. It's almost a 5 crore increase, whereas the revenue increase is around 3 crores sequentially. So could you possibly explain what is happening in the non-rating side? Because we've already committed more than 50 odd crores to the risk solution business. And directionally, we're not seeing any signs of cost rationalization or profitability. So could you give us a direction of a 2-year, 3-year perspective that when do we expect to break even? What are the kind of products which are in pipeline and when do we start seeing the real benefit of the same?
Okay. I have my colleague Jinesh, who is our CFO, who will take this question. Yeah, Jinesh.
Yeah, hi Sahil. As mentioned that we are developing various products for the company. So the certain products which are on the research phase are, put in as in a P&L for which we'll get a benefit for a longer duration. As you mentioned that there are certain 2 products which are already these are on go-to-market stage. So for those products, certain expenses were incurred for developing the product, which qualified as a research cost, which cannot be capitalized, are put in the P&L. That is why if you see our other expense has gone slightly higher compared to the previous year.
So could you quantify this number? Because a 5 crore increase quarter on quarter. And in the previous interaction, you said that this year will be the peak year of investments, whereas in fact, the expenses are really increased materially.
It would be difficult to quantify the differentiate between all other expenses, but on the approximately around 2 crores would be the research cost for this product, which are already live on the live stages, and certain products will go live in the next year. So both have been considered this year because they are already in the process of development.
Okay. And the other question which I asked, sir, meaning how many products are in development and monetization phase? And in the next 2 years, what is the roadmap? Because we've already committed around 50 odd crores. In fact, there has been a change in the management also, is what I understand. And it becomes very difficult for our investors to understand how much capital will be further allocated to this business, because we are not seeing any signs of reduced profitability coming through.
So there would be a 2 product largely which will be go to live in this fiscal, that is from till next March. So that is one. And as you mentioned that we have selected a certain product mix which we will focus on based on the market requirement. And in couple of years, we see that we will be break even for this entity as well.
Nevertheless, I would like to have the perspective directly being given by Abhishek, who is leading this business. Abhishek, over to you.
Right. So as Jinesh mentioned, I think there are 2 main areas that we are focusing on. One is the credit risk management, and another is the credit monitoring phase. And our products are getting built in this area, and we see a lot of traction coming from banks in India and the neighboring countries. So we are very confident that our focus in these areas is going to yield results very soon. Yeah.
Sure. And just a related question, sir, in terms of capital allocation. Sir, how do we really see the allocation towards all these new initiatives? Because we've already committed large amounts of money. Is there a timeline till which we will commit more funds to these initiatives before we decide to further invest? And second, on the cash which we are continue to build up on balance sheet, the dividend payout compared to the cash which we have is being subpar. So any thoughts on these two aspects, sir?
Okay. I think you're right that the capital allocation to the non-ratings business has been one of the major chunk as far as our investments are concerned. We believe that these businesses, they were required to be built as far as their importance for the overall de-risking at the corporate level, at the group level, as far as the concentration of the revenue profile is concerned. Yes, it has taken time. And we are not denying that aspect. And we are quite candid in terms of stating also that these are difficult businesses which shall be required, but they are important from a diversification perspective, and we remain committed to that. Having said that, we are absolutely conscious of the fact that the break-even in this business, principally the risk solutions business, our analytics business, that is something which is of paramount importance. And how best and how early we will be able to get that is the absolute priority of the management. And that is why all the actions that we have been taking in this regard, they are quite oriented towards that. At the same time, let me also weigh in the aspect that the other division over there, the advisory consulting division, has indeed reported a marginal profit as compared to the loss over the last few years. So the point is that at times, you have to be patient with these businesses to gain traction. Right? At the same time, you cannot lose the focus as far as the profitability aspects are concerned. So we believe that, and we are also quite conscious of the fact, working closely with the management of those subsidiaries to ensure that over a period of time, the investment from the parent company side has to taper down. Right? And that is an absolute focus and the KRA for the management over there. There cannot be any second opinion on that, right? And so that's a significant focus which is going from our side on that. And we believe that the traction that we have started getting now should lead to a further sustenance and momentum to be created over there.
Sure, sir. No, appreciate your candid responses, sir. Anything on the capital allocation related to the cash on balance sheet and the increased dividend payout or buyback?
Yeah, I see, as we have been articulating our position in the previous years as well to the suggestion of the buyback. All the suggestions which we have been getting from the investors to the call or from any of the sources, right, they are indeed put up to the board, passed on to the board for an appropriate consideration. And all capital allocation strategies, the options before the board, they are quite intensely looked upon. Right? And at appropriate time, if the board feels there could be a decision in this regard, but it's entirely the prerogative of the board in this for this. But irrespective of a buyback or a dividend payout, we believe that the capital appreciation for our shareholders, we believe that through our performance, we have been able to create that thing. And to that extent, our future endeavor also shall be that all the initiatives that we are taking should be generating the right kind of a value creation for all our stakeholders.
Sure, sir. Thank you so much. And just a request, if we can give a little more
Sorry to
disclosures
interrupt,
on the non-rating
Mr.
business,
Sahil.
it will be really helpful.
Surely, yeah, thanks.
Thank you very much. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Devam from Ardeco. Please go ahead.
Yes, hello sir. Actually, just wanted to understand that you provide a rating stability metrics in your presentation. What, and if you look at that metrics and look at the different buckets that you are showing over there, does it imply that your basically first thing is that your rating stability is higher than peers, and the other thing is that in the double B and single B categories you are way higher than peers. Is that the right understanding?
Rating stability has to be looked at from the perspective of the ordinality for each kind of rating category. So it is expected that higher the rating category, the overall stability in those segments should be higher. So as we move from AAA lower down the line, and our stability is depicted against the trend line of the industry average, right? So from that perspective, the rating performance has to be looked at. So the ordinality which I am again emphasizing is that the higher rating categories should be displaying a greater stability, and on an overall basis, the investment grade rating should also be continuing to display a greater stability, right? So from this perspective, the rating performance has to be tracked consistently and within our overall philosophy of the quality-led growth. So the focus remains absolutely that all the investment grade ratings, that we should be very diligent about and vigilant as far as the future trajectory is concerned. Nevertheless, I will also request my colleague Sachin, who is our Chief Rating Officer, to give his perspective on the rating stability. Sachin, you would like to add something?
Yeah. Hi, thanks. So yes, as Mehul was mentioning, we have a fairly high rating stability. On that chart, I would like to focus on 2 points. One, we have given a trend of how we have improved in the more recent 5-year period than the earlier 5-year period. So there, if you will notice, both in single A, double A and triple A, all 3 rating categories, our rating stability has improved. Rating stability essentially means that, how many, for 100 ratings in a given category, say for 100 outstanding AAA rating, what percentage of ratings did I move away from AAA? In case of AAA, it can only be a downgrade. So that number, which was 97.7% for the last period, 5 years, for the recent 5-year period, which is 2020-2024, the number is 98.2. So it's improved. Similarly, it's improved for single A and double A categories also.
Absolutely appreciate that point, that for AAA, for example, what you're saying is that 5 on 1000 you have improved the rating stability. My question is basically just that since you in the entire average curve is below your rating stability, are your ratings more stable than competition? That is as per the data you have compiled, and that's what we are very, especially in double B and single B, we are having a huge lead on the rating side on rating stability. Would we be right in surmising that from this graph?
Right. So you're right. So across the rating categories, the stability of our ratings is superior than average. And yes, you're right, the gap is wider, as you've correctly noticed, in double B and triple B categories as well.
So does this reflect in any pricing power or any sectoral area where we have any pricing power compared to peers because of this superiority that we have in the stability rates?
Stability and pricing and stability are not related in any manner. Right? So this is pure performance of the predictive capability of the ratings which have been assigned, and in correlation to that and how the movement of the rating is there. Pricing doesn't come into the picture in any way.
Yeah, just a basic intuitive understanding would be that if the rating stability is high, that means the rating product bears a higher quality, and generally a higher quality product should get a pricing power. But you are saying that was not the way it is looked at.
Does not necessarily work out that way, Devam, that the AAA and AA category would mean that the pricing in that category would be definitely be higher. Only thing which generally would be that as compared to say a double B category, mid corporate, where the size of the debt which has been rated, right, could be on the lower side. While in case of a large corporate, where the size of the debt which is rated could be on the higher side, right? That is the only difference which comes into the play. But per se, pricing as a parameter in rating stability, there is no direct correlation.
And can one say that if the overall market grows more, and also if you can give cues on, how the whole private raise market has fared in the last 1 to 1.5 years, and what would be your outlook for the coming 1 to 3 years? And over there, if that private market grows more, then one should be able to see some more pricing power coming in?
See, as the private capex and the private market, the overall the bond markets, they develop and continue to do well. It definitely augurs well for the top line rating agencies, right? So there is always a greater revenue in terms of having a good share of the overall growth in the market, right? So from that perspective, yes, that if the private players, if they go for more market related borrowings and like that, the top rating agencies, they tend to benefit out of it.
And if you can share any flavor on what kind of
Sorry to
practice you're
interrupt.
seeing over there right now?
Sorry to interrupt. I request you to rejoin the queue for your follow-up questions.
Sure, just this part which is connected to the current question. If you can see, if you can just give some flavor on private capex side, yeah. That's all.
Private capex has been eluding us for some time now, right? But as I mentioned in my opening remarks as well, since the average capacity utilization in the manufacturing sector is now at a level where ideally basis the past data, it should be reflective of the capex cycle kicking in. We believe that it should be a matter of time before it happens. The fact that it has not happened is also a reality that has not impacted as far as our growth is concerned, but certainly as and when it picks up, it would be definitely be a good thing as far as the industry is concerned, right? But at the same time, let's also not turn our attention from what the global developments are, all the geopolitical developments and the uncertainties which are there, which definitely hover over the minds of any corporate before they are committing themselves to a substantial investment. So these aspects, they also have a role to play in the decision of the corporates to ultimately go for a significant investment as far as their future capacities or diversifications are concerned. So all in all, yes, to the basic question, if private sector capital expenditure kicks in to the expectations that everybody is having, right, then certainly yes, the industry is likely to benefit out of it.
Thanks, that's it from us.
Yeah.
Thank you. The next question is from the line of Parikshit Gupta from Fair Value Capital. Please go ahead.
Thank you for the opportunity and congratulations.
Parikshit, you're not audible.
Is it better now?
Yes, sir. Continue.
Yes.
Thank you. So I was just saying thank you for the opportunity. My only question is to understand, I believe the Finance Ministry has a manifesto of having a domestic sovereign credit trading agency. Just wanted to hear your comments on that part. Thank you very much.
I think as far as we are concerned, our decision is based on our assessment of the opportunities that we need to tap. When we decided to go in as far as foreign ratings are concerned, it was clear in our mind that there is a space which can get created and which needs to be filled by an institution domestically, right, which has hitherto has been the domain of the global rating agencies, right. So we had the conviction in terms of taking that step, and we believe that we have taken the right steps until now, and we are already on at a stage where the company is already incorporated. So per se, I mean, as far as the government could be having its own priorities and the decision-making, policy-making things which could be correlated to this. But that does not have any direct correlation as far as we as a commercial independent entity to decide our future course of action.
Understood. Thank you very much.
Thank you. The next follow-up question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah, hi. Thank you for allowing me a follow-up. So, sir, my question is on this approval we've got for ESG ratings from the regulator. So, in terms of timeline, when do we launch it? What is our readiness in terms of product team? What will be the strategy? And then, what can be the revenue potential? Maybe not immediately, but in the next 3 years, we can be looking at.
Okay. Rajiv, first and foremost thing is that the ESG rating license that we have got very recently, that is on 2nd of May, we have received this thing, right? So, but the license is already there and we already have a team in place, right? And now it's a question in terms of taking the next steps in terms of getting the mandate and going ahead with that. So we believe that very soon we should be able to operationalize it from the angle of actually assigning the ratings on this, right? So our teams are already working on this, and we have been taking this groundwork, preparing the necessary infrastructure, having the right kind of analytical team, right kind of the management team over there. All those steps had already been taken even before the license was issued to us, right? So from that perspective, we are fully ready, and now it's all up to our business development teams to get the mandates, and we should be ready in terms of actually assigning those ratings. Right? Nevertheless, I will also be having my colleague Rohit, who is leading this business, and before I hand over to him, the kind of products which you mentioned or you asked for, right? So the products in this regard would be the ESG core ratings, there is a transition rating, there is combined ratings, or the products which have been defined explicitly by the regulator, what an ERP can provide. All these products, they are going to be provided by us. Let us also be clear that as we talk, these ratings are not mandatory per se. That is at the discretion of the corporate how to go about it. But to give a further perspective, it would be good to hear directly from Rohit also. Rohit, your views?
Yeah, thanks, Mehul. And Rajiv, not to repeat Mehul's points, but just to say, re-emphasize that we are ready to roll out the ratings. We just have to go to the market and start looking for mandates. And on this front, our strong corporate relationship which we have developed over the last 30 years will be useful for us, because we will be sharing our BD resources with our parent, which is CARE Ratings. And regulator allows us to share BD resources between ESG ratings and CARE Ratings. So that definitely is a big positive and a big boost for us. So as the business starts coming in, we are in a place to assign ESG ratings. We have 6 products, 3 on the plain ESG rating side, and 3 products are on the core ESG rating side. These products are mandatorily required to be put out as per the SEBI regulations. So the 3 products that I'm talking of on plain vanilla 3 products are ESG ratings, transition ratings, and combined ratings. Combined rating is combination of ESG rating and the transition rating. And similar 3 products are there on the core ESG side. By core, what we mean that SEBI has put out detailed guidelines on BRSR reporting. And BRSR reporting also has one subset, which is called BRSR core. The ratings done on the basis of information obtained from BRSR core parameters will be called BRSR core ratings. So that would be our product contour, and we are ready to assign ratings across these 6 product categories.
No, thank you for this elaborate answer. And just lastly on this, broadly in the next 3 years, how do we see our mix of overall consolidated mix moving between domestic rating and the non-rating put together?
Rajiv, in the previous interactions, I had mentioned that progressively we'll like to move towards an 80-20 kind of a mix, right, with the 20% coming from the non-rating businesses. That's over a period of time. This year, actually, we have reached up to over 10% contribution coming from the non-rating businesses, which was 6% last year. We have made some progress on that, and in the future years, we shall be giving greater focus on this. And when we are mentioning about this, let's also be clear that everything in this regard, this increased contribution is coming on the back of a sustained growth on the rating side as well. Right? So when the overall pie is increasing with the rating also driving the overall thing, but at the same time, this contribution from clearly coming from the non-rating businesses, that is also helping. And when I talked about the rating growth, the subsidiaries on the rating side, they have also been contributing and consistently growing. So I think it's an all-round growth that we are talking about.
And just last one clarification, will you also ensure that the overall consolidated margin don't get diluted because of higher share going up from the non-rating segment, which is right now, at the margin, making some profit or making losses, but it will keep on improving. But overall share going up by say 10% will ensure that the overall consolidated margin still keeps on going up, right?
I think the overall consolidated revenue when it goes up, here if you are talking about the impact of the increased contribution of the non-rating businesses in terms of suppressing the consolidated margins, we have to be conscious of the fact that every business has their own margin profiles, right? So the rating margins per se cannot directly be correlated with an analytics or a consulting advisory kind of a margin. So ratings generally tend to have a better margin in this regard, right? But nevertheless, irrespective of that, the fact has to be that over a period of time, the contribution of the non-rating businesses, if it increases at a group level, that augurs well in terms of withstanding any kind of a fluctuation which potentially could be impacting any of the businesses, right? So it has to be looked from a larger angle, but some impact because of an increased contribution, it cannot be wished away, considering the fact that the businesses are entirely different.
No, sir, very clear. Thank you. Thank you, sir.
Yeah.
Thank you. The next question is from the line of Devam from Aredo. Please go ahead.
Yes, sir. Can we share the total revenue, EBITDA and PAT for the Africa Mauritius entity for FY24?
FY24, anyhow, once the annual report is disclosed, you will get the greater details, right? But in a broader sense, Dinesh, can you give a broad perspective?
For Africa, it is the revenue is around 10 crore, and the PAT margin is around 30%, 35% PAT margin for Africa.
Sure, sir. And so what would be the current market for ESG practice generally, and what potential do we see there in terms of numbers? We understand obviously that it's a great diversification, but also what would be the current market and what potential do we see there in terms of numbers over the next 2 to 5 years?
See, when you are talking about ESG practice per se, that's largely related to our consulting advisory business, right? ESG rating is different, ESG practice in the consulting advisory is different, right? So let me just bring in my colleague Swati, who heads the consulting advisory piece along with the ESG advisory to give a perspective on this. Swati, are you there?
Yeah, hi. So essentially, if you really look at it, the way ESG advisory business is growing, it is, very difficult to say a number because, different elements are getting added to it, primarily driven by the regulatory regime, the customer requirements, which could be both nationally or in the international market, and the requirements in the supply chain. So essentially, if you really, ballpark numbers, if you really look at it, who are the bigger players are obviously the big four, and then there are a lot of these other agencies also. So the market can be anybody's guess in that sense. If you break it down into various segments and say, okay, BRSR reporting or generally reporting segment, ESG integration segment, then you can still have some kind of concrete numbers. So from that perspective, I mean, we at Care Edge Advisory, we are very well positioned. If you really look at our practice, we've grown by more than 100% over last year. We are very well positioned across all the value offerings that we have in the ESG advisory space. And we will be continuously receptive to the changes in the market and continuously keep evolving ourselves in terms of our capability as well as our delivery tactics and the delivery outcomes to meet the challenges and the needs of this market. I hope that answers.
Yeah, thanks. That's it from me.
Thank you very much. That will be the last question for the day. I will now like to hand the conference over to Mr. Mehul Pandya, Managing Director and Group CEO, for closing comments. Thank you, and over to you, sir.
Yeah, I would like to thank everyone for joining this call. I believe that, and I hope that we have been able to address your queries. For any information, you can get in touch with our team at the company level, or can contact SGAs, our strategic growth advisors, who are our investor relations advisors as well. Broadly speaking, I believe that, and re-emphasizing on the aspect that the trust and faith of the investors that you reposed in us all through, and the support that we have got, that has given us a lot of confidence in terms of taking new initiatives, and in the process over a period of time work towards creating better stakeholder value creation. So thank you so much for joining this call, and wish you all the best.
Thank you. On behalf of Care Ratings Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.